Hello, good morning, guys. Welcome to my VFS channel. All right, so thank you very much for having time to click on this video and also staying along. All right, so what did we discuss the previous slide? That's lecture 6. We discussed about why candlestick matter, the popular candlestick patterns, and also the key details of a candlestick, and also using candlestick in trading and candlestick risks. All right, so in lecture 7, what we'll be discussing, about uh, the key content. That's market condition, bullish markets, bearish markets, ranging markets, and also choppy markets. All right, so without wasting much time, let's begin. All right, so the market condition. So the markets in a period of time may be in a condition. So the condition of the markets can be a bullish market, a bearish market, a ranging market, and a choppy market. What do I mean by a bullish market? So a bullish market means that it is making a series of higher highs and higher lows, which means the buyers are in control of the market. What do I mean by bearish market? So bearish market means a series of uh, lower lows and lower highs, which means the sellers are in the market or the sellers are in control of the market. So what do I mean by also ranging market? So ranging market simply means that the market is moving in a range. It's moving in two boundaries of prices. Yes, so that's a ranging market. And also a choppy market. So a choppy market is basically a market that you should not trade. So when it is not bullish, when it is not bearish, when it is not raging, then don't trade it. Then it means it's choppy. If you can't spot trends of bullish market structure, the bearish market structure, the ranging market structure, then it means it's a choppy market and avoid it. Yes. Okay, so now let's continue with the bullish market. So as I said, the bullish market means that it's making a series of higher highs and higher lows. So in the picture right here, you can spot that the market doesn't move in a straight line. It's not straight, it's not vertical, but rather it moves, goes up and makes a retracement. Goes up, makes a retracement. So this one is called an impulsive move, which retraces another impulsive move, then it's correct. Impulsive, correct. So right here you can see impulsive, it corrects or retested. Impulsive move, correct retested. Impulsive, correct retested. And it continues like that. So the notes right here that I wrote down here. So you have to note that at higher lows are also known as cheap prices. So we want to buy at the lows and sell at higher highs because prices are expensive at the higher highs. The market is just like the normal markets we have been going. If prices are higher, we tend to buy less or not to buy at all. And now when the prices are lower, we buy more, or that's where we are interested to buy the market. You get it. But if the prices are expensive, we don't buy it. We rather sell. So when the price is expensive, we sell. So at the higher highs, we want to sell, and at the higher lows, we want to buy. So that's what we'll consider. So the next one is the bearish market. So this is the bearish market structure. So like the bullish market structure, the bearish market structure also makes a series of lower lows and lower highs. So lower lows and lower highs. So this is supposed to be lower highs. So lower highs and lower lows. All right. So the lower lows or the higher lows are profitable for sellers because sellers, when the price is if the price at the peak and they sell, which means they will make much profit. Do you know why the sellers will make much profits? Because at the higher prices, they sell. And when the price drops, that means they can buy again and now sell it when it gets to that point. So they buy it, so they sell at high and they buy again at low. Do you get it? And they wait when the price becomes expensive, they sell again. So that's what they do and they make profits for that. So higher lows are profitable for sellers. So you want to sell at the higher lows and buy at the lower lows because price is cheap. Yes. All right. So the next one is the ranging market structure. So the ranging market structure, as I said, it moves in a price range. So the when you look at the notes that I wrote, it says that in this type of market, there is no clear trend of a bullish or bearish market structure, but the market creates strong zones above which is called the resistance zone, and it also creates strong zones below, which is also called the support zone. So we will sell at the resistance zone and buy at the support zone. So yes, it's in a range. So it means the market will go up, come down, go up, come down. So it means at the upside, that's the resistance line, we'll be selling. And when it gets to the support, we'll buy. Because at the resistance line, price is cheap. So price is expensive. So we'll sell. And now when it gets to the support, it means price is cheap. So we buy. So that's what we are going to do until the market changes its direction or condition. Okay. So choppy market, as I said, choppy market, we don't trade it. So a choppy market, also called a sideways or range bound market, is when price moves back and forth without a clear uptrend or downtrend. Price fluctuates within a tight range, no strong bullish or bearish direction. Candlestick show no clear momentum, and that if trends cannot be, so you have to note that if trends cannot be properly seen, then it is a choppy market. So stay away, please stay away from such market. So what's the difference between a choppy market and a ranging market? So the choppy market, you see it's making a small, they say tight price range. So the range is very, very tight. It's not too big like the range bond. You see how wide the distance is. So the choppy market is not like that. The choppy market is a small, very tight range. That price has decided to move in that range. So there's no clear momentum and cannot be properly seen. Please stay out. Okay, so what are the tips I want to give you on this lesson? So I want you to know that all market structure can be identified on all time frames. But I personally recommend that it should be only be determined on the higher time frame, like the daily time frame. So I did the daily because I think the daily is much very important than the other time frame because I believe the daily is gives more information than the other ones. Yes. So for safety, when a trend is bullish, you want to enter a buy trade on the lower lows. So as I said, when a trend is bullish, so like here, we don't want to sell at the higher highs, but rather we want to wait. When it gets to a higher lows, then we'll get a bigger catch. Comparing this to this, this is better. So we want to wait. When it gets here, we catch a better move, not selling here and buying here. No. So I recommend that you wait when it gets here. So when it's here, you wait. When it comes to the higher low, then we enter the market to buy. All right, and the same for the bearish market structure. When it's at the lower highs, you want to sell. But when it gets to the lower lows, you don't want to buy, you want to wait. When it makes a lower high, then now enter a sell in the market. So that's what I was trying to say, that it's very safety. Yes. So and also for safety, when the trend is bearish, you want to enter a sell trade on the lower highs. As simple as that. You are doing well. following throughout to lesson 7. It means you really want to be a professional trader, and you are going to be a professional trader because you never give up. Never give up on the learning. So I want to say keep learning. And now a tip for lesson 8 and lesson 9, lesson 10. So now lesson 8 and 9, I'm going to make it very, very practical. So lesson 8 and 9, you are going to focus. Lesson 8, you are going to focus on drawing zones, how to draw zones properly, like I do. And also, you are going to talk about how to find the lower highs. I told you that you have to wait for this highs. Lower highs. How will you wait? So I'm going to show you how to catch the lower highs, how to know that this is a lower high. So it's going to make this move. So we are going to discuss all in our lesson 8 and 9. That's very practical. And our lesson 10 will be on risk management. So all of the slides, the rest of the slides is going to be very practical so that you can trade the market with the information you have gotten. So well done on the journey to lesson 7. So now I will encourage you to continue to lesson 8 and 9 and 10, which is going to be very practical, and you're going to learn a lot. Yes, you're going to learn a lot. All right, so thank you. That's the end of this lecture, and I would say it is a bye for now. Thank you very much.